Morning all. How are we all doing? We got there Friday, got through it all, just about. Hope you all stayed intact. Morning lads, how you doing?
Morning.
Hello, hello.
Everyone right?
Yep.
Knackered.
Yeah, tell me about it. Yeah. I think the chat room's going to be pretty empty probably from around 2 o'clock, 3 o'clock this afternoon.
Oh yeah.
So anyway, that's what we're here for. Put in some hours. Right, lots to get over, so I'm going to crack straight into it. Going to sort of try and keep it in chronological order. Don't know what good that will do, but I'm going to have a go. So we're going to start with the good old ECB. They hiked as expected to 25 pips. In the statement said inflation continues to decline, but is still expected to remain high for too long. The Governing Council's future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary to achieve a timely return of inflation to the 2% medium target. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. That word restriction was the main theme of everything at the ECB yesterday. It started off in that statement by them losing the guidance that rates will be brought to sufficiently restrictive levels. Lagarde then in the presser, just picking out the key comments really, growth to remain weak in the near term, but then strengthen a recovery. Economic and inflation outlook is still highly uncertain. Yesterday's decision was unanimous. The data and our assessment of data will tell us if any and how much ground we'll have to cover. We are open-minded in September and subsequent meetings. Then it all got very dovish. September could be a hike or could be a pause. And then this key line right near the end said, do we have more ground to cover? And she said, at this point, I wouldn't say so. That was pretty much as strong a comment as Powell's we are restrictive on the policy. So everyone's done. It's pretty much been a carbon copy of the FOMC in terms of the outcome. The market now seeing a top in ECB rates. At most we get one more. We're heavily data dependent. Then we got the usual sources stories out, but nothing too inflammatory on that. Basically saying some ECB policymakers currently favour a September hike and others want to pause. No real, nothing really enlightening from that. One other little bit of news, and this seems to be a little bit of a two-step, is that the ECB apparently debated raising banks' mandatory reserves to 2% from 1%. Not long after, Powell came out saying that he supports receiving a comment on the proposal to raise bank capital requirements for those guys as well. So both banks looking at potentially raising capital requirements, just making sure banks have got a bit more liquidity in the pocket should rate hikes start biting or impacting. Might be seen as a bit of a liquidity measure, a bit of a, you could almost pencil it as a bit of more tightening, you know, making sure that money's sitting in the vaults rather than going out into the economy. So that's it from the main key lines from the ECB. As said, pretty dovish overall, market sense in the top. Dollar got Euro got absolutely smacked on it, as I'm sure you've all seen from your charts. And you can see clearly on the chart there. All the way down, pretty much over 200 pips, just over 200 pips. The loss taken up this morning. And thus, this is where we sit at the moment. Now, also, one big reason why we got such a big smack was pretty much in between the ECB announcement and Lagarde waffling. We had a ton of US data. And again, it blew the bloody doors off. GDP came out 2.4% versus 1.8% expected. So big jump for flash Q2 number. Personal consumption, i.e. spending, 1.6% versus 1.2 expected. On the PCE side, we got first quarter numbers, 2.6% versus 4.1 previously. Core PCE, 3.8% versus 4.9% previously.
See, those were the most important numbers in my opinion, and people just completely ignored them. Because the issue is prices, it's not employment, it's not any of the other stuff, it's prices, and prices are dropping. And market just completely ignored them. But anyway, we'll get PC today. We'll talk about it later.
Yeah, I don't think ignore them, because the Fed's on pause. So you know what these numbers going to do. They're not going to pause the Fed anymore. It probably just draws down the potential for that second hike. But the market is now seeing a soft landing. So you know, who in the Eurozone has got 2.4% GDP at the moment? You know, we'll cross the Eurozone numbers, some of the Eurozone numbers that have come out. So I think the market already knew what the Fed was doing. Inflation's still going the right way. There's no need to hike. Now it's a question of how fast will they cut? And numbers like that, durable goods up 4.7% versus 1.3 expected. Initial jobless claims came in at 221 versus 235 expected. So these suggest that the economy is doing well enough that rates are likely to stay higher for longer, but there's still no insinuation that we're going to get another hike. And I think that's what the market's bought dollars on. But you're right, we get the PCE today, but I always get confused about this, because obviously that Q2 data contains, or should contain, an estimate for June PCE. Now we're getting PCE a day after the GDP. You've got to think they know the number, and we're expecting PCE to come in a little bit softer. I don't think there's going to be any surprise there if it does. I think the big surprise will be if it actually went up. So I'm not sure the market's going to read too much into that PCE data, but I don't know how they calculate it. I don't know whether they know the June number for the GDP or not, but it's just one of those quirks that pops up now and again in the calendar. Any comments you want to make on the US numbers and the ECB before we move on to our mates across the water?
Well, me, I just, you know, what we saw yesterday from the ECB was dovishness, and for me, the general macro scenario is still the same. Price pressures are lowering. Central banks are stopping. What happened yesterday was it was a bit weird, because effectively in the past few days we've had the Fed tiny bit dovish, more dovish than expected. The ECB definitely more dovish than expected, and yields rising yesterday. So how do you explain that? I don't know. I think there is a very good explanation, actually. The market had been very, very short dollars. We were talking about that, and also short bonds. Long bonds. So I think definitely some short covering or long covering, you know, depending on how you look at it. I think this move in yields and this spike in the dollar are going to be relatively short-lived, because, as I said before, the main global situation is still that of price pressures abating and central banks not tightening more. So let's see what happens. But we definitely did get the dovish ECB yesterday, and you know, without a doubt, I think they do one more and we're done, right? Or something like that.
Yeah. Okay.
Okay. First of all, just a little apart. The proposed hikes in reserves for the main banks has been on the card. It's like part of the final Basel plan, they call it. But then, yeah, yesterday they decided to bring it out both at the same time, the ECB and the Fed talking about it. But the pressure on the banks on each side of the pond is likely going to be roughly the same percentage-wise, depending on who's more already how shall I say, in line with those Basel plans than the other. But I don't think that should be a big mover, unless there's some hidden bodies also somewhere. But they were talking about the 8 major US banks, and I think, if I'm not mistaken, it's 10 or 14 or so, or even less European banks. So I don't think that's going to be a big mover. And perhaps that in somewhere that may have kind of underpinned perhaps rates a little bit as well. But I mean, I leave that in the middle really. Yeah, so both dovish. It seems that Lagarde took Powell's speech and then, being a lawyer, threw it in a different wording, but they both roughly said the same. Interesting is that all the speakers afterwards, unless I missed one, are starting to be okay for a September pause, and then perhaps one more later. I think that's probably going to be similar both sides of the Atlantic as well. I found the ECB also a bit dovish. It looks as if I was at least half right that those meetings were the last hawkish meetings by Lagarde. And as I said, it's a bit funny that even the hawks are now talking about or feeling comfortable to take the word pause up in their speeches after the event. On the price front, although we see this morning from the German states that it's slower, it's coming down slower. I think that's probably going to be roughly the same with all the major economies, because they kind of wrestled with the same shock, although there's been less money poured into Europe than in the States comparably. But yeah, I think it's really, and it's starting to be an old record, but we are going to have to, in my opinion, at least, that's my opinion, we are going to have to look at other data than pure inflationary data, even though they are important for rate decisions, but they may be less important for what's going to happen between one and the other. And if you look at the real data, we have seen over the past week that US is still showing slightly better numbers on the GDP front and on the PMI front. We have seen, and that I reckon explains the snapback in the dollar post ECB and the Fed. Also, one last addition to that, we are in end of month territory. So yesterday, as we already often repeated, and I've been saying that every month, we were trading value date end of month with the usual US corporate activity, and that will have accelerated the dollar purchases into the London fixing at least, but it continued a little bit afterwards, and then yeah, the Bank of Japan scud that was sent out in the market hours before the Bank of Japan did the rest, right? Because that drove all the end crosses massively lower and was weighing on stuff like euro, Aussie, sterling, and on risk. So that's then a different story that we've seen in the evening during our night.
Yeah, that's what we'll move on to now. The good old BOJ. And as Kay just said there, we got. I was sitting here after the GDP number, thinking, "Oh God, my position's not looking too hot." Going into that, because obviously I flipped my last week's long to short, around about 140.5, and we got the data, we got the ECB, and we were up here in the 141s where I did knock on a bit more. And then that sources piece dropped from the Nikkei, and they were pretty much bang on the money with it, and that there was going to be a tweak to YCC to allow rates to move over the 0.5% band, and that's what happened. We also got 12:30 last night, Tokyo CPI, the first July numbers for CPI, and that was up in the headline number 3.2%. Let's put it up on the screen.
Yeah.
There we go, 3.2%. Some had it as expected at 2.9% for that CPI number. Oh, there you go, 2.8%. But that was revised up, the prior number, so it was higher, but it was revised up again. Core CPI beating expectations, but it still came in a little bit down on the prior month. Main CPI 2.5%, up 2 pips there. So still solid numbers from Japan, keeping the pressure on those guys there. That helped keep dollar yen where it was, although it was a little bit jumpy before the announcement. And then they came out with the announcement that they would be guiding the yield curve control more flexibly. So they're going to allow it to move above the 0.5% range, but they will cap it now at 1%. Rather than capping it at 0.5%. In the statement, they said it was appropriate to heighten the sustainability of monetary easing. They will operate yield curve control more flexibly to respond nimbly to upside and downside risks. We'll keep offering fixed rate operations for 10-year JGBs at 1%. The decision on YCC was 8-1. There was a dissenter, Nakamura, who wanted a bit more on the YCC change. They also hiked their CPI forecast. This is one of the points we've been looking for. 2023 CPI, this is fiscal year 2023, was hiked to 2.5% versus 1.8% prior. The core was hiked to 3.2% versus 2.5% prior. So quite a big jump for 2023. However, they did temper that by lowering 2024 to 1.9% versus 2% prior. And the core was left unchanged at 1.7%. Just on the forecasts there themselves, and particularly that inflation, do you think that them lowering the 2024 forecast was purposeful, Kay, just to take a bit of the heat out of the upward 2023? Because obviously they can revise it further down the line.
Yeah, exactly. I think that is a signal that they are okay. Just give you my two cents on what's happened there over the BOJ. I think the main word, and we spoke about that, Ryan, together. I think the main word here is change. They changed something, okay? They have been stubborn. Okay, Kuroda already widened somewhat, but that was brought over as no monetary policy change. Ueda actually said both things today. He at one stage he said it's equivalent to a monetary policy change or rate hike, and then he says it's not part of normalization, which is I'd say typically Japanese. But I think the main word here is change, and we were wondering how fast this would go, right? So changing the CPI and then putting it lower for the year after is, in my opinion, sending a signal that we should not expect them to go massively throwing everything overboard and start to raise rates massively and stuff. Widening the YCC, it is a move, right? Because one could argue that they now put the ceiling to the double of what it was before, which is, if you look at something which is 3%, and then they would put the limit at 6%, that's massive. But okay, I mean, it's 0.5% and it's going to 1%. The 1%, it's clearly on the picture, is a red line. I think that's on purpose as well, that they are ready to intervene. Whatever the market wants to offload, they are ready to give it to them at or to buy it at 1% max. And I don't think they will let it go to 1% straight away. So we may have, I think JGBs ended around 57 BPs or so. I guess they will like let it go in little steps into the September meeting. So perhaps the first level will be 60 bps, then 75 bps, and then very, very, very gradual up to the 1% if needed. Because if in the meantime they're buying time again, if in the meantime CPI does show a bit of weakness coming in, then Ueda seems to be dovish enough to step into the market and go like, right, this is enough for now. The last thing that really and that keeps really ringing in my head nearly every day is that famous line between Suzuki and Ueda when Ueda took the job, saying that they will closely cooperate. And somewhere I really think that Ueda is more actually a government guy than a Bank of Japan guy, and he will not want the Japanese yields to start to rally too far, because he knows that I don't know how much the percentage is of GDP now of the government debt, but it's absolutely gigantic over there, and they will not want to let rates go higher to put these stimulus, these spending needs and stuff, the financing needs in jeopardy. So that is about it. The market is probably right in trading the change, but now for how long will it last is a different question, because if you talk about even letting rates go to 1% and the rest being equal, if you took it is the 10-year JGB, so you take the 10-year dollar rates, they're around 4%. There's still going to be like minimum a 3% differential for now, unless the data in the US start to collapse and the yields in the US go lower. So is it a case for being long yen for longer? It can come in quick shots like we have seen last night and overnight, but for the longer run, I'm still not overly comfortable with saying that is it for the yen. Now yen is going to strengthen materially and for longer.
Yeah, no, I agree with that. I'll give my quick thoughts just after I finish off what Ueda was saying and so on. In the statement, they had their assessment of the economy, and they say that it's likely to continue recovering moderately. The economy is to continue expanding above potential, and inflation expectations are showing signs of heightening again. And then, pretty much like all the central bankers, Ueda did talk sort of both sides of the coin, saying that stable inflation with wage growth is not yet in sight. But on the yield curve, depending on market situation, yields can go above 0.5%, but they'll make sure it doesn't go above 1%. Need to patiently continue with easing to support the economy. It is appropriate to maintain strong monetary easing. So as the pressure went on, he acknowledged, what the economy was doing, but then he just gradually got more and more dovish, or stayed in his lane. The big line here was saying that there's no change to the judgment that the achievement of the 2% target is still distant. So that's lengthening the timeline again to when potential tightening might happen. As Kay said, today's decision was not based towards tightening. We are not aiming for normalizing policy, but rather making yield curve control sustainable, and doesn't know yet if the BOJ's bond buying will decline. So yeah, we got a change, and typical for the Bank of Japan, it's one step forward, 10 miles left to go. So it is a small change. We thought that the BOJ would be doing something in this meeting, whether it was forecast, whether it was action. They did both. So we have come out of this more more hawkish than we're going in. But I agree with Kay. How long that lasts in the market remains to be seen. For dollar yen, we're funny enough, we're pretty much where we were when we were going in to the announcement, just before the announcement. Obviously, we had this big move down already, so the market had already got a big sniff of what happened there. Then we got real blow around when the market was digesting it, and really for 20 minutes the market wasn't really sure whether it was hawkish or not, and we had 2 moves up to 141s and 2 moves down to 138s. It really needed some settling, and then the market, I think, came around to the fact that we've had a change, but it's a small change. It's not huge change in policy, and that's why we had picked up again towards 140. But we're going to see a lot of this. I think a lot of this two-way action. The market's still judging what's happening over there, what to really do with it. So I'm expecting to see a bit more chop perhaps as we go through the day. The Yanks will probably react to it when they get in. Keep an eye on yields. That move up in JGBs actually helped yields in the US, yields globally moving up. We had a move above 4%, but that's eased off a bit now. So, we don't know if this moves are going to be maintaining, but a lot of reaction to this, and there is some fallout across markets. People saying that if the Bank of Japan making these moves, is going to put the pressure on other markets, other bonds, other yields, other assets. So there's a lot to come out in the wash yet from this. But overall, the price action and my plan, it's gone as I wanted it to. I've made money on it. I got my long from last week, managed to flip it around to short, managed to get some money off there. I didn't quite get down here. I got out of it, some of it 138.80s, and then the rest I got out in the flip 140.60. So did what I need to do. I've got an option on, a call on, 142 call on that expires today. Just a quick play, cheap play, 20 pips, just in case this announcement wasn't seen as hawkish and we're going to rock it up. I don't think I'm going to be getting anything out of that one later on, but we'll keep an eye on it. You never know what happens in the US. Right, before we get really stuck into the prices, just want to have a quick look at the ton of data that was out this morning. German CPI, regional numbers, all coming in slightly softer. That we did see a big uptick in inflation in these inflation numbers last month. That was because of base effects from last year, transport subsidies kicking in. So they haven't come down as quickly. If that's all washing out, a lot of the regional numbers just dropping by a pip or two. Then we got the first of the GDP data. France with a bit of a surprise there, coming in at 0.5% versus 0.1% expected. CPI as well coming down. Flash numbers from France as well, just coming down more than expected on the HRCP, as expected on the CPI, but confirming a move lower. Spain has been a bit of an outlier. CPI went up. Their headline CPI at 2.3%, well above expectations of a drop to 1.6%. HRCP as well coming in 2.1%, again above expectations of last month. GDP coming in as expected, 0.4%, but you'll notice the difference here. We're getting 0 point numbers from the Eurozone, whereas we've got that whopping 2.4% in the US. So this is what we're going to be trading. PPI in Italy, down still both negative month, year. Not as much as expected though, but the direction is what's important. As you can see there, the rest of the CPI numbers from Germany, the regionals down a pip, some unchanged, so on and so forth. German GDP coming in minus 0. Oh no, hang on a minute. That was wrong, isn't it? Came in at flat, didn't it? GDP.
Yeah, I think it was flat quarter on quarter. That's what I saw.
Yeah. Okay, let me check that one.
It's flat quarter on quarter.
No, it's been. Oh no, it's flat. Silly ass. Yeah, it was flat quarter on quarter.
Yeah.
So that's a wrong number there, unless Reuters have got it wrong, because Reuters printed it as flat versus 0.1 expected. I suppose
they would have corrected it in the meantime if that was a wrong one, the flat one.
Yeah, no, minus 0.2 was the year-on-year number. So I wonder
Yeah,
if they,
for the seasonally adjusted.
yeah, so that might be a wrong print there. It
Yeah.
came in flat. Surprisingly, I thought it might have been worse. I think even 0.1% was going to be optimistic given the data we've had at Germany recently. So anyway, that was the Eurozone data. So no recessions circling around just yet. And of course, we've had the floodgates open on all the ECB speakers. I hate the day after the ECB. They all come out the poxy woodwork. Stornoras, if September hike comes, it will be the last. Muller, near-term GDP outlook is worse than a few months ago. At the current rate level, ECB decisions are no longer obvious. Vasley, September meeting could bring a hike or a pause. I get paid the big bucks to say things like that. Well done. Simkus, we are close to a peak or at the peak. Casimir, one of the big hawks, we are nearing completion of monetary policy tightening. I'm still waiting for an answer to what's coming in September. Today, our mission is still not fulfilled, and we should take a firm step further. Even if we were to take a breaking step, it would be premature to consider it the end. So maybe one of the last holdout hawks in the ECB there, but everything else is to be decided, sitting on the fence. Right, so what are we doing now then? Well, as mentioned, we've got the PC data later today. And again, I'm not sure what that's going to show us, given the numbers we've had in the GDP numbers. So I'm expecting this maybe to come in softer than expected based on those GDP numbers, PC on both measures. Just a quick one, we might need to pay attention to this, the employment cost index, not something many people look at in too much detail, but Powell mentioned that they would be watching this number today. He seems to do that, or has been doing that recently, doesn't he? Dropping in these little data points that they now apparently are watching, which gets the market looking at those. So we'll keep an eye on that one.
Yeah,
sorry, mate?
good, yeah, absolutely, good spotting. It seems like in every other meeting he drops like a bit of a keyword. And
yeah, we're watching this, we're watching that. Yeah.
Yeah, and that's not randomly picked. I reckon that is giving the market something to, well, some insight and perhaps managing. That's part of their managing of expectations. I reckon, like telling the market, okay, we are looking at this. So if this moves in combination with this and that, then this may be assumed. And it's been very interesting because he's been doing it for, I think, for the whole of 2023, even part of 2023, when they really started to ramp up the hikes. Every other meeting or so, he drops like a little keyword in there. Ryan, can I just say something about these German CPIs? Because they came out, because they seem to be very stubbornly high. But I've read at least two strats who said that they are still high because of base effects, because in Germany there's been a lot of injections and relief measures towards the summer and last year, and they would still be now because of the base effects. These German CPI looks to be still very high, but both of them expect that once the summer is over, those CPI data would start to come down quite rapidly, because, and I cite one, for the fourth month in a row, food prices have been dropping, and the prices for clothing have dropped sharply. And against that, the holiday prices were up. But yeah, I mean, that's also after the pandemic, people want to go more on holiday, and we've seen it in the past. But that was a little side note on those German CPI data. They may seem higher, and but we have to wait exactly to see what's going to happen in the coming months.
Yeah, and it was actually something I raised yesterday. I asked someone, I'm just trying to find who it was who I asked about that, because we obviously had that jump last month, and I didn't know whether that was going to continue or not. because that transport subsidy that they put in place lasted for 3 months. It went from July, August and September. So I wondered if we were going to see a continuation of that. And like the guy I was speaking to, very respective, I respect his opinion, said that likely not. So, you know, maybe it's a bit up in the air as to whether that is or not. But yeah, definitely something to maintain. If we suddenly see it crap out in September or October, you'll know exactly what it is. But yeah, coming back to the rest of it, final Michigan numbers later on. Not sure they're going to give much input into anything. The market's probably going to run out a bit of puff later on, take some profits and whatnot. So yeah, just keep an eye on that Michigan number in case there's a big variation. But otherwise, after PCE, we're probably going to die a death. So back to the charts. So where are we after all this? I mean, that's the main question. And sorry, Steve, I will bring you back in a moment.
No, it's all right.
You know, whenever we have these big events, these big weeks, lots of data, lots of central banks, whatever, the first question I ask is, have we gone anywhere new? Have we broken ranges? Have we stayed in ranges? Because that tells you whether something's changed or not. Now, still might be early days, but, you know, look at the chart. We're still below 142. We're holding 138. So for me, there is no reason, or there's nothing from all these events that have shown me $yen wants to trade somewhere new for now. We're sticking in the range. For everything that's gone on, we're in the range. And so that now sets you up to trade it going forward. We're going to be entering the summer months. Yeah, we've got NFP next week and whatnot, but things are probably going to quieten down in between data points and things like that. So we've got a bit more confidence that we can trust these ranges now. And that's what I'll be looking to trade moving forward. Pick the ranges, look at all the pairs, go through them, see where we haven't broke, where we have broke, and trade in between the levels. Same old homework we do before. Same could be said for euro dollar. Yep, we've had a breakdown from 111, 110, but you know, we couldn't even get as far as 109, you know, this 38.40 area. We've pulled up ahead of that. Bounce is looking a bit weak, so we need to see how much further it wants to bounce. If we can't get back through 110, keeps this short-term trend in play on the bearish side. We're going to be watching the data, obviously. But if we get a further move down, can it get below my old zone down here, 108.30, 108.70? If we can't do that, then maybe we're setting up a bit of range trading through the summer again. Obviously, it will all be data dependent once more. And, you know, pretty much every pair you look at, it's the same situation. You know, cables had the move down. We're now finding a bit of resistance coming back sort of 128 up around this fib, finding a bit of resistance there after the move down, but we've still got plenty of levels down below. So we might need to see a bit more of what this wants to show. If we have another move down to that low, around 27, 60s, 70s, and it holds, then again, maybe we're setting up a bit of a range. But for this week, where do we mark a top? 130 after the break. So the levels are showing up. Let's say for cable, might need to see a bit more definition on the downside to see if it's finished going down. If it has, fine, we're trading the range again. Aussie dollar, I might have missed this one. I was looking at maybe having a little nibble down into the low 66s. We got down to this 66.20 area, which has been a bit of a on-off minor support and resistance level going back quite some way this year. Down into 66, 65.90 is the stronger level for me. Didn't quite get there, but again, need to watch the bounce. You know, is it going to be strong enough to get us back up at least to 67? Got a bit of a traffic zone here, but it's a bit wishy-washy. But as I often say, it may do nothing here. It might do something on the way back on a revisit. So again, check your ranges. You don't want to be getting in the middle here. Let this range play out. See what it wants to do. Go with one side or the other. Dollar China, that was another one to keep my eye on. Are you still long this one, Kay?
Yes, sire.
Still a bit long on this one.
Yeah, but a
look,
bit. You know, I'm not nowhere near full speed on that one. But yeah, I mean, that blue zone down there, we are watching it. 7-11s and 12s. For as long as that holds, I'm in. I could trade it around a little bit. So whatever happens, it's not going to cost me anything. It would be a shame if I had to be stopped around 7, 10.5 or so. But in the meantime, yeah, I mean, I need to see, as I said, a close below and hold below the PBOC CNY fix to tell me that investors are changing tack, and then yeah, perhaps we will have to trade the other side. But if you look at the US data coming out, there is not really too much of a reason to think the dollar will lead it. So we'll have to look at what China wants to do, right?
Yeah, I mean, I'm still a bit more on the other side, but on the bearish side, just the price action. You know, even just making that fresh low yesterday. You know, just I don't like seeing that price action when it breaks it. No, I know we've got a bit of a zone here, 11, 12. So you know,
and it bounced.
No harm, no foul. But the bounces are now looking a bit weaker. But I'm not sure we're going to get a move higher that I would consider tapping. And if we do get a move higher, it might be breaking this downtrend anyway. So, yeah, I'm a bit neutral to bearish on this one for the moment, but not at levels I'd like to jump in at. So,
I'm nowhere near full conviction either. It's
yeah,
and I'm playing now off that level, and that'll be it. If it goes below there, we'll need to reassess, I think.
Yeah, cool. Stel, you got any thoughts on the metals?
Well,
just after all the events and moves and stuff, has anything been game changing there, or are we just mooching around again? Ranges.
I think we're still ranging. Gold is very clear. The levels are well.
You saw me put the silver chart up, and you went for gold.
Oh, sorry. Really, the ranges are very clear for gold. It's still 1895 and 1985, and we're ranging in between. Yes, we're currently we basically stopped yesterday at the 50 DMA, and we bounced off it today. So, what do I think about yesterday's move? It makes it makes some sense, because what happened was we had the slightly dovish Fed, and then we had the dovish ECB. So what happens? The euro drops, and that means that the Dixie rises. And the markets and the algos, they look at the Dixie rising. Oh my God, dollar strengthening. So we have to sell metals, which is the immediate reaction. It makes no sense, but that's what we had. And we had 3% down on silver. Silver is quite volatile, as everybody knows. I think I was lucky enough to have sold the third of my position. When was it? A couple of days ago, and I'm looking to reload. But at the moment, I think we're still ranging, and we are at the mercy of the dollar and of yields in terms of the metals, I mean. But I have absolutely no doubt in my mind these are going to be resolving to the upside. The question is how and when do we get there? And the reason why I say this is that I do think that inflation is going to be low, at least for the next, the rest of the year. I'm not talking about, 2024, 2025. I think for the rest of the year, we're going to see softer inflation. We're going to see central banks stopping. And I think we're going to see yields grinding back lower. Of course, all this can change if inflation decides to if something happens and drives inflation higher. But from what we have seen and the reasons why we've had the inflation that we've had over the past few years, the logic says, and mathematics also say, that it should be grinding lower towards target for the Fed, and eventually for the ECB and the UK are a little bit more difficult, but for the Fed definitely. So my opinion is, as I've always said, and I think I said that on the chat room when I took that third off in silver. I always said, when something's going well and the market's still choppy, take some off, get some in the bank, and then try and get in again, or trade around your position basically. So I still think we should be very nimble with our positions, and the way I do it is I scale in and I scale out. Everybody who's a member knows that, or who's followed me, and so I still think we're ranging. To answer your question in one word, we're ranging, but I took 6 minutes to do that, right? So
that's still quicker than Lagarde took to answer one question yesterday. I think that took about 10 minutes to answer a question. All she needed to say was we're data dependent, and I even typed that in the chat room that she's gone a long way round saying we're data dependent, and she was still answering the same question while I was typing it in the chat room. So yeah, well done. You've learned more from the master.
yeah.
Right, just before I hand it over to Kay, a couple of questions in the chat. Ali, I think I've answered your question on the data. Mike, do you believe it makes sense to get long cable around 128 going into the expected BOE hike next week? I don't know if it makes sense right now. We really are still trading, or going to be trading, the aftermath of everything that's happened this week. We have had a move under 128, which looks like a typical quick blast through stop run under there, but it did try and stay below there, and as I say, we're knocking on the underside of this fib at the moment. So I don't know if now's the time to be trying to catch the knife there, but if you want a tight trade, you can do so. 128 for the Bank of England, which we'll talk about in more detail next week. I've had enough of central banks this week. We are expecting a 25 pip hike. I think that is probably appropriate. I think everything that's happened with the Fed, the ECB, drawing down of rate expectations for the BOE as well. The BOE is a reluctant hiker, and I think they'll use this opportunity to scale it back to a 25. Maybe they'll go at 50, but if they go at 50, that'll probably be a pause or top 50. That might be a last one, but we'll chew over that next week. Kate, do you want to take it round for a couple of pairs? Not too long, because I'm knackered.
Yeah, I'm going to keep it quick, mate.
How many? Tell me how many you're going to do. If you go over, I'm going to take you off.
I'm not an accountant, mate. How can I say? I mean,
I'm going to give you 4. There you go.
Yeah, okay. Let's be clear about something. The only thing I care about is my buy and sell button. Numbers matter very little, Okay. Now let's keep an eye. Let's look at this euro dollar. As I said, this 109 quarter and a half, 109.40, 50 would have shown up. In any case, I reckon coming down there, and it does. Okay, we tried to get below. It dipped below, but we're still holding levels here on the euro dollar. And I reckon that's one to keep an eye on for the end of the week. On the upcoming US data, that's going to be a pretty decent level there, in my opinion. Rebounds, what do we see as rebounds? Perhaps already 110.10, and then the 30-50 zone. Few visits over here. Yeah, this zone here, anywhere between 110 quarter and a half, could be enough. We have, and you tweeted about it as well, Ryan. We have updated on what the end of month flows could be. I'm not going to repeat them here. You look at the tweet. For those in the room, we have in the newsroom, we have there's a few models showing up what there is to do. So I wouldn't be surprised if for the end of the month, actually, barring a blip, it could relatively hold and we trade the range. What's interesting though is, and I spoke about it yesterday, was that 111.5, and that held even just before the ECB, and then especially through those US data that we saw coming out stronger. So I guess there's your end of month range. I would say, even though looking at the divergence between EU and US data, I think we may already find some resistance around the middle part of it. The cable was an interesting question. We've broken through this trend line, but it's a bit of a steep one, okay? And then we've broken through 128, but we are holding those prior highs here around in the mid and the low here around the mid 127s. Also based on what could happen on month end, it may be just enough for this leg, and I wouldn't be surprised to see cable trade I don't know, around 128, 50, 60. Yeah, I'm relatively neutral, but I'm keeping an open mind that we could see a little bit of potentially weaker dollar or a little bit of strength in the other currencies based on what's happening in the equity markets this month. So I'm traveling extremely light in the dollar. I was long dollars yesterday, took my profit too early, but anyway, I think it's not too bad to take profits, and then I'm a little unsure about what's going to happen, but I would not be surprised if we see a little bit of a bounce here. Euro sterling, not going to really comment on that one. Yeah, I'm starting to think that next week Bank of England may see the spike in sterling, and then we need to reassess. That's just an early feeling that I have on the sterling. Moving over to the yen, look at how good Ichimoku clouds are sometimes. We did the top and the bottom of it over the Bank of Japan. Well, I mean, there's your next levels. I'd say monitor that cloud for a starter. It is going to direct yen moves. Again, there, if you look at what the models are saying, don't be surprised if we see a retest of the lows. That's all I can say. And then the big levels will be here, right? I think that is going to tell us beginning of August whether the yen is going to materially and for maybe more medium term start to strengthen. Okay. And there's one I want to show, and I'm looking at the clock. There's one I want to show here, MEX yen, okay? Because people are asking questions about carry trades, right? And is it time, or will the carry trades get mullered, or you know, look at this. It started at the end of roughly at the end of, okay, even earlier, but that's a reactionary move after the pandemic more. But I think really, and I really started to talk about that as well. And in those days, I was rather in the euro yen then, but in the euro mix then, but then mix yen. But look at this, okay? And you can overlay, you can do the whole move, or you can even do only the 2023 move. This is end of 2022, and you can even start there. And people are asking, okay, the carry trades, are they all stepping out of the carry trades because the yen is going stronger? Well, look at it technically. If you are a very short-term player, it's not really a carry trade player, but still you want to take a bit of positive carry with you, and the MEX has been so strong. Look at this, okay? I think the short-termers, they have been scared during the month of July. So one could argue that this break of 830 has seen some run for the exit. But then you look at the daily 55. The 55 is up here. We held it, okay? We held it. And then you look at the fib. We're not even going to test the 23.6. All right. So well, my personal opinion, everything is, I think the long-termers have not really been tested yet. And we will have to break through levels for a starter, 8, then 770. Then the long-termers may start to think, okay, there is more going on in the end here, or perhaps the Mexican Central Bank is starting to say, okay, this is it, we are starting to cut rates. then you're going to see this unwind, I think bigger unwind of the carry trades. For as long as we hold these levels, it's a little bit like Stell is continuing to bang on about. There's nothing really bearish about equities. Well, is there something bearish about carry trades for the yen? I'd argue perhaps not yet. So that's what I wanted to show today. I could do a lot more, because if risk falters, this one is starting signs of perhaps going out of this bear flag, the dollar knock, and there's a lot of stuff to happen. But I reckon now we're going to be in end of month territory. Keep it in mind. There may be some strange moves coming. And that is it for me. Ryan, back over to you, mate.
Thank you very much, mate. We're nearly there. We're nearly there. What a week. Good week. Volatile week. Lots of moves. I hope you've made money on it. I hope you've not lost money on it, more importantly. We're always here to offer support. If you have any questions, need to, something you want to know about trading, something not working right for you, let us know, and we can talk about it. A problem aired is a problem shared, as they say. As always, a big thank you to Stell and Kay for their input this week, here, the chat room, everywhere to do with ForexAnalytix. Thank you especially to you folks for coming to the Flow Show and giving us your support, making this all worthwhile. Please have a good rest of your day. Have a wonderful weekend, a relaxing weekend, and we go again on Monday. Thank you very much, everyone.
Thanks, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.